Real estate is one place where you do 12 different niches that will roll up to real estate. What is asset management from the owners? You're also the loan sponsor. So there's a deal sponsor and a loan sponsor. Got real estate full-time because it was more profitable than our real jobs. $968,000. We spent almost $1 million improving it. We have $541,000 in cash. We're able to keep and own 60, 70, 80% of the deal. So where I got this money from, I made relationships with investors. I know you guys, a lot of you guys are starting a business. My kids are considering when they go to college starting a business. And so one of the things I love about real estate is, especially commercial that we're doing, is you're tying in so many different types of business niches into one asset class. A business niche is sales. So you want to sell, I would always recommend young people learn how to sell. Because if you can sell, you're first of all going to make a lot more money at a much younger age if you can sell. Anybody that runs a company, they're not going to care how old you are. If you can sell, you're going to get paid well. You're going to make a lot of commission, and you're going to move up the ranks quickly. So when I was 24 years old, I made my first 150 grand, right? By the time I was 28, I was making $300,000 or $400,000 a year. If I had done something else, like maybe be in management or in medical or even a doctor or an engineer, I would have never made that kind of money when I was 28 years old. So sales is one business niche. Another business niche, as Norm mentioned, is property management, right? Like Cleveland State has a whole property management school and a whole property management curriculum on how to underwrite and review deals and look at leasing and management of buildings, right? So that's a whole nother niche of business is management. Another niche is finance and accounting, right? You want to study finance, you guys are studying finance, you want to get into private equity or investment banking. One whole part of real estate is the equity that comes in. We'll talk about debt and equity. The equity that comes into a deal is always, it could be, there's a bazillion different ways to bring equity into a deal. You could be in finance and you could be on the debt side, meaning you're basically working with a bank and the bank is funding the first mortgage. They're funding a big part of it and it's debt. Debt is an obligation. You have to pay it back, right? So debt is a whole nother niche. Then equity is a whole nother niche. Some guys work in investment banking, private equity, or family offices. And they're all different forms, and they get their capital from different places that all invest in real estate. That's a whole nother niche, okay? Then you have all the marketing. You have the marketing of the buildings, which we'll talk about today. You have the marketing of yourself to raise equity, which is a lot of what I do. That's why Alex is here. To make videos and put out content and gain followers and gain views in order to build your personal brand in order to recruit capital. Okay? That's what I do. Okay? So that's why Alex is here. So instead of me going to family offices and investment banks and some of these large institutions, huge institutions, I focus more on my personal brand to recruit equity. And we'll talk about how beneficial that is when it comes to how much of the deal do you own, right? At the end of the day, if you have a big check writer, like an institution, and they write a big part of your deal, and they buy into your deal, they're going to take a lot of the ownership, and they're going to take a lot of the profit, okay? If you raise your own equity, which is what I do primarily, we're able to keep and own 60, 70, 80% of the deal. For me and for my partners. My partners, obviously, Eddie's father, Glenn, and then Tyler. So we've been able to build a huge amount of equity in a very short amount of time that we would never be able to do if we were getting institutional capital from like an investment bank, okay, or private equity. So we'll talk about that today. So there's all these different niches in business that all roll up into real estate, okay? The whole other piece of it is construction. So as you guys get older, you might want to focus on construction or construction management, right? So that's a whole nother business niche that rolls up into real estate. So do you want to be like super handy and be a carpenter? You could do that in real estate. Do you want to do construction management like Dave? Dave's our basically owner's rep or VP of construction. You could do that. right? So you can basically manage all the workers and manage all the subcontractors. That's something you can do in real estate. One of Glenn's main roles in our company is when we in the office, we talk about being in the clouds or in the dirt. Are you in the clouds or in the dirt? So I think Gary Vaynerchuk made this famous. If you guys are familiar with Gary Vee, talk about in the clouds and in the dirt. So you got to have both. You have to have executives or business leadership in your company that are in the clouds, meaning they're not really in the field, or they're not picking up a hammer. They're not actually doing leasing. They're more in the clouds, thinking through spreadsheets and numbers and analytics. And people in the dirt are like the guys actually doing the construction, the guys doing property management, the guys doing leasing, the guys doing, the financing, accounting, the maintenance tasks that are in the field. And to me, I think this is where the secret sauce happens to build a company. It's how does leadership that is usually operating in the clouds perceive people in the dirt? Some leaders think they're too good or better than. Okay, I'm up here in the clouds and I own all the equity, I make all the money. These guys just work for me. And it's like almost this like slave mentality, like I own you, you work for me and go bust your ass so I can make money. Or the other way that people look at it is, and this is the way I look at it, is I view myself and I view Glenn and Tyler and our leadership team as what I call servant leaders. Okay, servant leaders. The servant leader is somebody who ultimately you realize that everybody else has to eat first. And if everybody else eats first, everybody else does well. Everybody else enjoys their work, enjoys what they're doing, and they're making money, and you're leading them, you're making their job simpler, easier, but still pushing them to execute at a high level. They will all eat well, and leaders will do incredibly well because the people that work in the company feel like they're a part of the puzzle, right? The puzzle can't be this big with just the owners and then all the pieces sitting on the outside. It has to be a puzzle that fits together where there's all the pieces. The leaders are part of the puzzle. People in the clouds and the dirt are part of the puzzle. Okay? They all work together. They're all interconnected. So, as you guys think about where you want to go, I'm going to work through kind of underwriting one specific deal, and I'll show you guys one specific deal today. I want you guys all to be thinking about, like, where could I fit? Where would this be fun for me? Okay? And the last comment is really like, you don't even have to do this full time. I've told my kids, they all know, I don't care if they get into medical, if they get into engineering, if they get into business, they have to do real estate on the side. It has to at least be a side hustle for them, at a minimum, because of the tax benefits, the rate of return, the diversification. They have to do real estate on the side. I don't care if they just buy some single-family rentals. I hope they don't. I hope they don't rent into commercial real estate. But they have to do it even on the side. So even if you guys are in, let's say I maybe want to get into investment banking, right? So one of the guys that we bought this building, I'm going to show you in a minute, the Acadian. The guy that we bought it from is a guy named Bob Orlean. Okay? You guys don't know the name, but guys in the industry know who Bob is. Bob is the former CFO of Forest City Enterprises. Forest City Enterprises is a publicly traded real estate investment trust. Publicly traded REIT. Okay, Forest City was started right here in Cleveland. They own I don't know, 30,000 apartments.
Yeah, they're a monster, in their prime time. Just huge real estate REIT, massive.
Yeah, you go to the Cleveland Clinic and you're going to see the Ratner name on buildings because they donated tons of money to the Cleveland Clinic. Easily $1 billion type of real estate enterprise. Started in Cleveland, was based out of Tower City downtown. Well, Bob Orlean was one of the major executives. Bob also bought some real estate on the side, just like I'm telling you guys. So he bought some deals just for him and his family. It's called ABC Management, I believe. They developed it, they built it. The Acadian I'm going to walk you through was on, you guys that like football? It was on HBO's Hard Knocks when the Browns were on HBO's Hard Knocks. Because the Browns coach at the time made the new coaches and the scouts live at the Acadian. Because it's right down the street from the Browns practice facility. So they actually talked about back then, the Browns coaches were on HBO talking about that the Acadian was a shithole. And Bob Worley got pissed because he heard that his building was on HBO and they were not talking about it. This is like 15 years ago. They were not talking about it like it was a great building. So he then showed up and did a bunch of improvements and tried to do some reputation improvement. Well, he owned it forever. We bought it from Bob a year ago. This is the case study I'm going to use. So again, a couple takeaways here. One, I don't care what you guys decide to do with your life, at least buy real estate on the side as a part-time. Number one. Number two, as you think about college and getting out of college, like, what do I want to do? Real estate is one place where there's 12 different niches that will roll up to real estate, where you could be in business, but focus on finance and accounting, or focus on mortgages, or focus on equity, or focus on property management, construction, all these things rolls up into one. Okay. The last reason why I like it is because it's 6th grade math. Okay. I tell people, I do these classes, you guys are on the classes on Tuesdays, I say it all the time. I said, my kids could do this math. Right, I'm almost 50 years old. This I could do on the back of a napkin. With a pen and a napkin and a calculator, I could underwrite real estate. So it's not complicated. Okay? So those are some big starting points. So what are you guys' thoughts based on all that? Based on full-time, part-time, niches, simplicity, anything jump out? Any thoughts?
I guess my first thought comes to mind, like, you're saying find something that is your niche, right? I think my niche, in this case, that would compare to what I want to do. Like, I do enjoy financial modeling, like probably underwriting, right? Like, you're looking at just straight spreadsheets and the numbers, they're there. Instead of being more like on the management side too, where in underwriting, you can still be like client facing, right? But I do like math. I do enjoy math. I think that's probably what I would try and focus in on.
Yep. So Norman, you talk for a bit about what is asset management from the owner's perspective.
So asset management, you are working with, the client's money. You are tracking your underwriting to performance. It's the next level up from, property management is where you're like, okay, are we leasing well? Are we collecting? Our financials tight, our rent rolls, are we in good order? Asset management is then taking those initial reports, comparing them to the underwriting. You're making your distributions. People like to make money. Are they getting their returns? Okay. Is it time to run a refinance? Or is it time to just exit this because we have squeezed everything we can out of this? And so you run all these different reports and models to help, the team make those decisions as to, yep, we want to hold this forever, or we're ready to move it. And it could, sales happen for a couple reasons. It could be change in the money, as I call it, like investors. They're like, hey, I'm at a point in my life, I need to exit. Okay, no problem. That's a life change. That happens. It may be that, hey, we made it through. It was a lot harder than what we thought, from our original underwriting and just plan. We're going to make money and say goodbye. And we'll move on to the next one because this one was just too big of a cross. So there's a lot of those happening. And what I will tell you guys, like as a dad, because I have two out of college, one in and one to go. And he's right. Like learning some kind of sales, like it will help you quantify things and understand how to quantify your performance. And that will set you apart. It doesn't matter what you sell, like just figure out something that you can get some experience, because it helped me when I built my company to go out and pitch clients for third-party management.
I had to call Jen.
You just
She was in here yesterday.
toughen your skin when people
Just ask
are
her
you're crazy. I'm like, okay, fine, next. Like you get confident that way. So he's spot on with that.
So I know this is tough to see because of the angle, but this is kind of how the stack is built as far as levels of ownership or roles. So you have ownership at the top. You'll also hear us talk about general partners. You guys probably should grab your pens and a piece of paper and start writing this down. So ownership. Usually you have general partners and limited partners. Okay. General partners like me, Glenn, Tyler, other ownership groups. are usually what are also known as the sponsor. Okay? You find the deal, you locate the deal, you underwrite the deal, and you're usually signing up for the loan. You're also the loan sponsor. So there's a deal sponsor and a loan sponsor. Okay? And ultimately, at the end of the day, the GPs are really responsible for the deal and their performance. Then also in the ownership category, you have limited partners. These are people that basically invest passively. Okay? Mike Dress, I've known Mike's mom and dad since I was 18 years old. Mike's parents have been limited partners with me before. Mike's Uncle Scotty has been a limited partner with me before. Okay, so these are limited partners, are just passive investors. They write a check to invest. That limited partner could be institutional money, like private equity or investment banks. Could be what we call a retail investor. Okay, so write this down. A retail investor is somebody that usually writes checks between $100,000 and roughly, let's say, $2 million. A retail investor is somebody that, usually is a business owner, a husband and wife, a mom and pop. Could be somebody that owns a company that does really well. Or it could be somebody who just is in sales and does decent, or even a nurse or a teacher, somebody who's married, engineer, whatever, and they just want to get a good return on their money. Okay? So a retail investor is my focus. So we're going to focus on that today. Okay? So you have ownership. Then, as Norm mentioned, asset management are the people that are sort of in the clouds, usually sitting behind a computer, looking at the underwrite of the deal, which is we're going to go through in a minute. How is the deal projected to perform? Okay, so when I say underwrite, what I mean is we're basically creating a business plan for every deal we own. Okay? And the asset management team usually works for the ownership, and they're comparing what we call projected or pro forma versus actual. Okay? Projected returns, projected cash flow, projected expenses, projected rent versus what's actually happening in the field and on the financial statements. Okay. Then 3, you have the property manager. Property manager is literally at the building. Okay, so we have a property management office right below this conference room. Those are the people that are here every day talking with tenants, leasing, collections, moving people in, moving people out, and maintaining the building. Okay? Under property management, you usually have leasing agents. Again, people doing collections, and so we'll just call this 4A and 4B. And you have maintenance techs. They're basically caring for the building. They're taking care of leaks, plumbing leaks. They're taking care of buildings and grounds. Okay? You guys have been doing a lot of buildings and grounds stuff all summer. Okay? So this is, in general, this is the group of folks that it takes to run a large complex. Okay, any questions on this? Norm, anything to add there? Anything I missed?
So that's pretty good.
Okay. All right. So, when we go through this, I'm going to show you guys the pitch deck and the underwrite and how we basically put a business plan together. Now, you can use this, as I walk through this, you can use this in almost any business. If you guys want, like, my Juliana shadowed Monday at Southwest Hospital. We have a friend of ours who invests in real estate. The last name is Patrick, Jack Patrick. Jack owns about 600 or 800 units of apartments. He's basically a retired firefighter. He got a job as a firefighter, and was, making firefighter money. Started investing in rental properties on the side. Bought a bunch of little singles and duplexes in Maple Heights, Garfield Heights. Bought them right after the crash. So he's literally buying houses for $10,000. Puts $30,000 into them, $40,000 into them, so he's into them for $40,000-$50,000. Okay. Then he starts renting them out. He's getting $1,000 a month in rent. So he's into it for $50,000. he's making about $10,000 to $12,000 a year in cash flow. Okay, that's going to be that. If you do the math, that's really good cash flow. He waits. The market starts getting better and better and better and better. Property values all go up. He exits almost all of those. Like 40 of them. Probably made a few $1 million and put a lot of that money back into apartments. Okay. Also put some money in crypto and some other stuff. So Jack and me are both he didn't go to college, but he became a firefighter, got a regular job. I went to college, got into financial planning, got into real estate as a side hustle, got into real estate full time because it was more profitable than our real jobs. And then got into commercial real estate. Okay. Jack's wife, her name is Rachel, a really close friend of ours. Jack's wife, Rachel, she was a nurse. So she graduated from college, graduated from Akron, became a nurse. She decided to become a nurse practitioner, right? So she got an advanced degree, nurse practitioner, making more money. Then she decided to start a nurse practitioner business. So now she has 20 nurse practitioners that work for her. She does really, really well. She makes a lot of money. Okay? So again, that's a perfect example of she has a passion for medical. They invest in real estate on the side. Got it? So a lot of different ways to kind of slice this up, right? The sooner you get involved in real estate, the younger, the better, because as it evolves and grows, you'll end up, probably be part of your portfolio somehow, some way. Okay. If it's not part of your portfolio, you're doing something wrong. Right? All right. All right. So let's jump into some of the modeling, because it doesn't matter if you're running a nurse practitioner business, if you're doing single family rentals, if you're in e-commerce, if you're into physical products. Everybody wants to look at a business plan. You guys want to get into investment banking or private equity? Guess what they look at all day? Business plans. They look at other companies creating business plans, and then they pitch those business plans to private equity. They pitch those business plans to investment banks. They pitch those business plans to retail investors. Right? So this all matters no matter what you get into. Okay? Any questions on that? All right. So let me go ahead and... All right. Any business is going to revolve around two documents. Balance sheet, and P&L. P&L stands for profit and loss statement. Balance sheet and profit and loss statement. Balance sheet, which is what you're looking at right here for the Acadian, is going to measure all of your assets and liabilities. Give me an example of an asset. What do you guys think an asset is that would go on your balance sheet? Something that's worth something. What's an asset? Money, cash? Yep. What else? The building itself is an asset, right? What else? Okay. Another asset is your improvements to inventory. Capital improvements. So I buy a building and I improve it. Buy the building itself is an asset. As I invest money into it and I do capital improvements, those improvements are known as an improvement to inventory. Okay, the building is inventory. It's an asset. In my inventory of buildings, I own a building, I improve it, it's an improvement to inventory. Okay, so that's an asset. Those are the basics. Okay, any equipment, like a trailer, golf cart, landscaping equipment, those are all assets because I can sell them all for cash. Okay, so the top of the balance sheet is always all your assets. Okay, the bottom of your balance sheet is your liabilities, right? It's what you owe. So, we bought the Acadian for, I believe it was $9.2 million, right? And that is right here. Okay? On the balance sheet, here's my building, $9.2 million, that's what I paid for it. We have improvements, $968,000. We spent almost $1 million improving it. We have $541,000 in cash, just sitting in that one company, $500,000 in cash. And then some of these other things down here, about, this is really the banking side of things. So when you buy a building, one of the things you're going to do is get a loan from a bank, right? Well, that loan from the bank is going to be in two parts. Write this down. You have what's called the initial funding. It's the initial amount of money the bank is going to give you to buy the business or buy the real estate. The initial funding. The initial funding is what you get at closing. I'm at closing and the bank wires me, let's say, $7.2 million. That's the initial funding at closing. Then the bank might also give you money for capital improvements. Okay? Also known as what's called a construction facility or some sort of improvement facility. Okay? So if I buy a business, doesn't matter if it's real estate or not, I'm going to get initial funding from the bank and I'm going to get additional dollars to improve the business or improve the real estate. Okay? So you can see this construction reserve up on your screen. This $1.9 million plus the $968,000 here, these two, this is money that the bank gave us to improve the building, $2.8 million. Now we're not going to use it all, but that's the amount of money that the bank's going to give us over 3 years to improve the company. In this case, improve the real estate. Okay, Eddie?
Was the taking a drop and swap?
Yes.
Yes.
Yeah. So a drop and swap is the seller owned the business in an LLC. We basically bought the company. We didn't just buy the real estate. We bought the whole business. So he took his interest in the LLC, dropped his interest into a new LLC, and then we bought that whole LLC. And when we bought the company, we bought the real estate with it.
And then in your video that we watched yesterday, you also said there's a lot of tax benefits with a drop and swap.
Sure.
Do you mind explaining those?
Yeah, so tax benefits that come with a drop and swap is basically the valuation of the real estate doesn't really change. Whatever the valuation is of from like the county or the state, whoever's valuing the real estate, because you're buying the whole company, you're not just buying the real estate. That valuation really doesn't change or shouldn't change much because you're not just buying the real estate. So if we buy a building for $5 million, or we just buy the real estate, then everybody knows we bought the real estate for $5 million.
Mm-hmm.
If we buy the whole entity, the whole company, including the real estate, all the trailers, all the assets, the golf carts, the equipment, the land, the leasing office, everything that comes with it, okay, and you buy that for $5 million, you're buying the whole business. And there's no disclosure of exactly how much did you pay for the real estate, okay, because you're buying the whole company.
Right.
So there's benefits to that because you're kind of sheltering it from everybody's knowledge. Mm-hmm. Nobody really needs to know what I'm paying for a building. It's my business, our business. It's not everybody else's business. So we do a drop and swap. We buy the company instead of buying the real estate. Make sense? Mm-hmm. Okay. Any questions on that piece? No? Okay.
Hey, quick one. Are there any advantages to the seller for that?
There's really no difference to the seller now. Okay. All right, so balance sheet. Then under here we have liability. So again, liability, we got $9.1 million from a bank, but they didn't give us all $9.1 million up front. The initial funding was the $9.1 million minus the construction facility of $2.8 million. So they actually advanced at closing $6.3 million. And I'm going to walk you guys through that in a spreadsheet in a minute. We paid $9.2 million. The bank advanced us the initial funding, $6.4 million. The bank was also going to give us $2.3 million. That actually went up to $2.8 million, which you guys just saw. So this is an old deck for $2.8 million. And then, so the total amount of money that we needed to do the deal was $12.8. Okay, which is purchase it, renovate it. We took a 3.5% fee when we bought it. So me, Glenn, and Tyler, we got that money and we split that money up between the three of us. And then we have some money that we put in the operating account and the escrow account so we have capital to run the business, okay? That was right here. For closing costs, $400,000 of operating capital, and then $200,000 of extra capital sitting in an account for interest reserve, okay? So you guys are in business school, you're gonna start to learn about sources and uses of money. So this is the uses of the money. So people give me $12.8 million. How am I going to use it to run this company? Okay? So I'm going to use it, first of all, buy the real estate, improve the real estate. I'm going to pay myself a few fees. I'm going to pay some closing costs. And then I'm going to have $600,000 in the account to run the real estate. Okay? Money comes in, money comes out. Money comes in from rent. I pay the bills in and out. Okay? So uses of money. Now, if you need $12.8 million, where are you getting the money from? That's the sources of money, right? It's common sense. It's sixth grade. If I'm going to use it here, where am I going to get it from? Well, my sources of money was initial funding from the bank, the money from the bank that is for the capital improvements, and then the money I got from investors. Okay? The limited partners, the passive investors. Okay? The $4.1 million from limited partners. Okay? That $4.1 million came from retail investors. Okay? It didn't come from one large check writer. It didn't come from a private equity company. It didn't come from an institution. It didn't come from an investment bank or any kind of institutional money. Okay? So where I got this money from, I made relationships with investors on the phone, on Zoom calls, cell phone calls, emails, text messages. I met new people, I interviewed them, they're interested in what we're doing, and I build that relationship with them, and then I make them an offer. Okay, Walker, questions?
So, I mean, for the private investors or the LPs, you gotta raise like 4.1, which would be your minimum. I might have heard you say like 100K, so you basically just had to recruit like 40 retail investors.
Right.
Okay.
Now, a lot of people wrote larger checks, so it's
Right.
might have been 40, but it was 20. Some guys wrote checks for $500,000.
Mm-hmm.
So average, probably $200,000 a piece. Our average retail investor, write this down. There's two types of retail investors. There's what's known, two basic types. There's a lot of different types, but two basic types. One is accredited. The other is not accredited. Okay? Accredited, there is a three-part definition that determines if they're accredited. Okay, so under accredited, write down 1, 2, and 3. So number one, they have to be worth at least $1 million, excluding their personal residence. So any equity in their personal house doesn't count. Okay, so accredited, number one, worth $1 million minus their house. Okay, accredited, number two. If they're single, not married, they have to make $200,000 a year for the past 2 years. With, you don't have to write this part down, but with a reasonable expectation that they will make $200,000 again this coming year. Okay, so $200,000 a year if they're single, $300,000 if they're married. That's the third definition. If they're married, they make at least $300,000 rent. So somebody is accredited if they fit one of those three definitions. So they have $1 million net worth, excluding their personal residence. If they're single, they make $200,000, or if they're married, they make $300,000. If they check any one of those boxes, they're accredited. Our average accredited investor has invested about $500,000 with us. They're in multiple deals. They might have 100 in this deal, and 150 in that deal, 200 in that deal, 50 in this other deal. They've invested in an average of $500,000.
Just curious, why wouldn't you go for more people, like, let's say someone wanted to put in like 10 or 20K and they're not ready to, or don't even have like the net worth to put up 500. And it's just like an efficiency thing, like it's just not worth your time.
Yes. Yeah, that's exactly right. And I'll explain, there's a couple rules around the SEC that we have to follow. I don't know if I'll get to that today, because it's a little bit more complicated.
What kind of loan did you use? Did you use a bridge loan or was it a Fannie and Freddie?
Good question. There's 3 types of loans. Write this down. 3 different types of debt. 3 different types of debt. Here's what's called permanent. Okay, when you look at debt, permanent debt, then you're looking at big institutions like Fannie Mae, Freddie Mac, and HUD. That's permanent debt. You pay it off usually over 30 years. Okay, long term. The second type is what's called bridge. Bridge is, so it's the opposite of permanent. It's very short term. It's usually 3-year money. You get money for 3 years, you use it as a bridge, to bridge yourself, to buy it, bridge the deal, and then get to where the deal is stabilized, and then you refinance or pay it off. It's very short term, like 2 or 3 years. And then in the middle, between the two, is what's called bank financing. So permanent, bridge, and bank. Okay, bank is usually 5 to 7 year money. Could be 5, usually 5 to 7 is pretty good. 5 to 7 year money. And the bank financing is usually the most flexible. It usually comes with a construction facility. It usually has pretty good terms, like interest rate is low. The only problem with bank is that you have to personally guarantee it. Write that down and underwrite it. Write that down, highlight it, underwrite it. It's what's called a personal guarantee. It's also called recourse. 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 Recourse means if you screw up the deal and they foreclose on you, they could come after you personally. They could take your house, your retirement plans, your money, your kids' money, every nickel you've ever saved. They can take it from you because you guaranteed it.
So it's super risky to do that.
Not really.
Not risky, but
Not really, because look at this. Okay, so this was a bank loan. I guaranteed $6 million. Me, Len, and Tyler. And we guaranteed another this is 2.3 and this would end up being 2.8 million. So we guaranteed to pay back the bank 10 point, well, the loan. Right here. We guaranteed they would pay the bank back, right here, $9.1 million. Holy shit, you owe somebody $9.1 million. And you personally guaranteed it. But, right, the building's going to be worth, when we're done, $17.6 million. So after we renovate it, we improve the cash flow, we raise the rent, it's going to be worth $17 million. So how much risk is there if you own a company that's worth $17 million and you owe $9 million? Is there much risk there? Not really. Especially when the deal cash flows. When you have cash flow coming in from tenants that pays all the bills. Right? So how much risk is there? I would have to have everybody move out of the building, everybody leave, I have no cash flow, then I can't pay the loan, can't pay the mortgage. So is it risky? It could be very risky, depending on the business plan. Right? That's why underwriting this and creating a business plan is so important. Okay? Okay, so let's stop for a quick minute. Questions?
So with South Hills, is that a bridge loan? Because you plan on selling it, like flipping and selling it, or is it different? It's bank loan too. It's bank loan too, because it was a 3-part deal. So it was 3 buildings.
Okay. Other questions? Okay, so what have we learned so far? Okay, what have we learned so far? Somebody tell me something you wrote down that you learned so far. Mike?
2 types of retail investors: accredited and non-accredited. There's 3 parts being accredited investor. You have to be able to work at least $1 million, excluding personal residence. If single and not married, you have to have made at least $200K in the past 2 years and are expected to make it on a year. If you're married, you have to make at least $300K for the past 2 years, and the average investment for retail investors for you guys is about $500K.
That's right. That's right. All Senator, what did you learn so far?
I said the three types of debt are permanent, bridge, and bank. Bank is 5 to 7 years, and it's the most flexible. And bridge is short term, and permanent is payoff long term.
Perfect. Juliana?
Balance sheet has assets and liabilities.
Perfect. Walker?
I said for a loan, usually you get your initial funding, which is kind of like an advance from the bank, and then you get your construction facility, which is meant to, it's just additional dollars to improve the building.
Yep. Ready?
Take drop and swap, buying LLC, getting the whole company, not just the real estate, just the building.
Good. That's pretty good, man. Solid, right? Teenagers, learn it. I like it. Okay. We're gonna take a break in a minute. But so this sources and uses. The reason why I bring this up to start is also the balance sheet, right? So that's what you guys. There's two important documents. First one's the balance sheet. Second one's what? P&L, profit and loss. So the balance sheet measures assets and liabilities. So purchase price, that's an asset. Renovation is an asset. Cash is an asset. Down here, you have the bank loan, liability. Rehab to improve the real estate, liability. Then you have private investors. These investors, this is key. This is hugely important. Write this down. Okay? These investors are known as limited partners. Limited partners are investing their capital with you, but they do not have a vote. They do not decide how the money is spent. They are limited. So they do not get to make decisions, but they also don't have any liability. They're limited. So they don't make decisions. Like, they don't call me up and tell me if I can, hey, you want to hire some interns this summer and have them do your buildings and grinds? Nope, I get to decide that. No one gets to decide that. You know, you want to invest $2.8 million in construction? They don't call me up and tell me how to spend the construction money. We get to decide that. Okay? They are limited. So once they invest, they now are kind of, what they're doing, like they talk about this, like when you guys vote, right? Vote for politics, vote for this. They're voting with their money. They voted to say, I trust Josh, I trust Norm, I trust Glenn, I trust Freeland with my money. I'm voting, I'm giving you my money. You, in other words, are a good sponsor. You're a good loan sponsor. You're a good operator. Okay? Operator. Right? People talk about Elon Musk all the time. How do you build a boring company, Tesla, SpaceX, AI, all this stuff at one time? He's a fucking incredible operator. He operates his businesses. And even for him, not only is he in the businesses, the one thing I love about Elon Musk is the fact that he's in the companies every day. He's like on the floor. He's working with his people. He's talking to his engineers. He's not in the clouds. He's actually in the dirt with his people every day. So you'll see for me, Norm will see it, you probably already noticed it, my staff already knows. Like, I'm in the field all the time. I'm in the dirt. I'm showing up, I'm secret shopping my buildings, I'm talking to leasing agents, maintenance techs, I'm talking to you guys, I'm seeing what's going on with property management a couple times a week. Okay? Because I want people to look at Freeland and say, dude, they're incredible operators. Because if we operate the real estate well, and we do well by increasing the income, guess what happens? You get more limited partners. Right? You can't get more limited partners and raise more money by being a shitty operator. You can't drive a business in the ground and raise more money. Okay? You have to build a company, start a company, raise some money, do well with it. Then tack on the next company or the next building. And tack on the next one, the next one, the next one. We've done that now, and I've raised $100 million from investors because we're really good at operating. We're not perfect. Things have gone wrong, things have happened, for sure. But we're really, really, really good. We're not perfect, but we're really good. So the only way you raise $100 million is if you can start to tell the story. We did this deal. We did really well with it. We sold it. We refinanced it. We did this deal. We did that deal. Right? Start taking people's money, investor capital. You gotta be really serious about operating your company. Really serious about operating the real estate, the property management, construction. How do you communicate with investors? All that stuff. Because these people are voting with their money. They don't have any recourse. The bank has recourse. The bank can come after me if we screw up. These folks could get wiped out. They could lose 100% of their capital if we screw up. Norman's seen it. I've seen it. Okay? We've seen these people just get demolished where they put in 100 grand, they got nothing in return. They literally lost 100% of their money. Or sometimes they make a huge return if the operator does well. Okay? We've seen deals where this guy gave people invested $4 million and collectively they only got $1 million back. So they lost 75% of their money. Oof. It's like buying a stock that goes from $100 to $25 and you've lost 75% of your principal. That sucks. It's happened to me before. It's a terrible feeling. But if these people are investing, they don't have recourse to come back and say, oh, you screwed up, I'm going to sue you. They can sue me, but they're going to lose. Okay? So anybody can sue anybody. It just depends on if you're going to win or lose. If we got sued, we're not going to lose, right? Because we disclosed everything in writing. That's the risk that they're taking. But these people are a big part to making this whole ecosystem work. Without them, I'd have to come up with $4 million of my own money. Okay? We've done well, but I don't have $100 million in cash to just fund my own deals with my own money. Okay? So the balance sheet, assets, liabilities. It starts on a deck like this, and it ends up in a document like this. This document is reviewed by CPAs, it's reviewed by our CPA, our CFO, it's produced, and it's given to the investors once a quarter to show the investors how we're using their money. Okay? Ready?
So if Freeland was a publicly traded company, would it be different when they're partners? Like, would it be still limited partners, or would it be, because with a publicly traded company, like when you buy enough stock, now you're like a majority holder, and they can kind of call the shots too. Like with forestry, real estate, like, was it a little different because they were a publicly traded company? Like, what's the...
So think about Elon Musk's companies, right? They're publicly traded, a lot of them. If you're a limited partner, you're also known as what? A shareholder, stockholder. Okay? So I have stock in Tesla. The girls actually have stock in Tesla. Yeah. But they can't vote.
Yeah.
Okay? So it's just the same in a publicly traded company. If you're a stockholder, you don't get to determine what happens with the company. Unless you're a major shareholder or you're on the board. But if you're on the board, you're a major shareholder, then you can fire people, kick people out, you can have a vote and remove somebody from the operation. Like, people are pissed at Elon Musk because he took the government job and went into Doge. And they're like, well, his companies are now suffering because it's just some political fallout. Because, oh, he's a Republican, he supports Trump, so all these other people, they can't, they don't want to support his companies. The liberals are all burning up his Teslas. Okay? So the stock price is actually down. That happens. So some of the major shareholders in Tesla are like, we want to have a CEO run the company because Elon Musk is a little too volatile. He's a little bit too much in the public eye. I get it. But Elon Musk is the majority shareholder of Tesla, so he's not going anywhere.
Yeah.
Okay? So yes, so these limited partners, notice they're right here, investor equity. That's the 4.1 million that I put on the deck. Final number ended up being $4,086,500. Those people have no vote. So we run the real estate.
Is your ultimate goal to have like so many properties where it cash flows so much that you can just use your own equity instead of raising investor money?
Yeah. If we exited all of our buildings right now, sold all the ones we have, and just reinvested all the equity, we're done. Retired, never have to work another day in our lives. So that's like, what we're waiting for now is the right timing. right, to refinance it. You know what I talked about earlier when you talk about asset management. Like, how do you manage the asset? Is it time to sell it? Is it time to refinance it? Right now, interest rates are still pretty high.
Yeah.
So as interest rates go up, valuations are lower because the cost of the debt, the cost of the mortgage is higher. Cost of the mortgage is up. There's not as much extra cash flow because the cost of the mortgage. Okay? If interest rates flow down, there's more cash flow. Values go up. So we're kind of waiting to see what happens with that. Okay?
So is a bank loan a part of the Fed fund rate, or is it part of the Treasury?
The bank loan is going to go off of it's called 1 month term SOFR.
Okay.
SOFR is going to be indirectly impacted by the Fed funds rate.
Okay, got it.
Permanent financing, Fannie, Freddie, HUD,
Yeah.
is based off of the Treasury, a 10-year Treasury, usually 7-year, 10-year Treasury. Okay. All right. So let's recap real quick, and then we'll take a break. Okay. So you have to invest in real estate part-time. I'm going to haunt you for the rest of your lives if you don't. Number one. Number two, we talked about accredited investors. We'll talk about non-accredited investors later. We talked about different types of debt. We talked about the balance sheet primarily so far. When we come back, we're going to talk about the profit and loss statement, the P&L. Then we're going to get into underwriting and looking at the projections versus actuals. Okay? We also talk about different types of investors. We'll talk about that before we break. We'll talk about retail investors primarily. Write this down. The different types of investors include, and I want you guys to kind of grab a piece of your paper and put retail investors at the bottom. You're going to need like 7 or 8 lines on a piece of paper. And we're going to talk about this when we come back. I'm going to bump through some of these different types of equity. But really quick, don't you have to write this down because we're going to cover it after break. But I just want you guys to hear this, okay? So, retail investors, investment clubs, what's called fund of funds, registered investment advisors, family offices, doctor groups or highly compensated groups, pref equity, and then institutional. There's about 7 or 8 different types of equity. Okay? You go back to this, there's about 7, 8 different types of equity I can go get. The bigger checks they write, the more of your money they want. Okay? So that's why we're going with retail investors, so we can keep control. So it takes a little bit of extra work for me to build all these relationships with individual investors, but they write smaller checks between 100,000, 500,000, $1 million. But when they write the checks, we maintain control. If I got the whole 4.1 million from one group, how much control would I have? Very little.
Not much.
Not much. Because if they write a big check, they want control. If I go to an investment bank and they write the 4.1 million check, the investment bank is going to tell me what to do. I go to private equity is going to tell me what to do. I'm not playing that game, right? I want control. So I spend the extra time to recruit and raise money from individuals so that we can maintain a lot of the equity and all the control. Private equity, institutional capital looks amazing. Wow, why not just get one big check writer? Because of control. Bigger investors you get, the less control you have.